So I quit my accounting job. I got into real estate. There, I started buying single-family houses. I did Airbnb. From there, I just scaled it up to buy a little bit bigger apartment building, so on and so forth. So fast forward since 2016 until now, we bought 250 units for multifamily.
For the newbies, entitlement in 30 seconds. What are the different steps from A to Z?
And lately, we found that assisted living is something that's a super high demand. So our company decided to also branch out into acquiring assisted living facilities.
Double your
If
money.
I can sell it for at a 10% cap, then I think that's heavy.
Yep. What do you need help with, Elsa? How can I help you on the deal?
You can definitely co-GP with us.
Okay, so today I am with Elsa Nguyen, and she is amazing. She went from getting a condo to then a couple hundred units in multifamily, and now moving into assisted living, which I think is going to be the next hottest asset class. And so we're going to dive into her story all next. Well, Elsa,
Hello.
welcome to the show.
Thank you so much for having me here today, Josh.
And I'm very happy to have you on the show. So just, can you paint the picture for people who don't know you yet? Who is Elsa? How did you get into the seat that you're sitting in?
First of all, thank you for having me here today. My name is Elsa Nguyen, and I am the co-founder of Investment Capital. We are a private real estate equity firm. We buy apartment buildings and we buy assisted living facilities. I studied marketing in college. I ended up getting a job in accounting, worked in that field for about 15 years, and I found out that my true love is probably still marketing and sales. So I quit my accounting job. I got into real estate as a real estate agent. And then from there, I started buying single-family houses. I did Airbnb. And from there, I just scaled it up to buying a little bit bigger apartment building, so on and so forth. So fast forward since 2016 until now, we bought over maybe about 250 units for multifamily. I did some land development where we develop a hotel as well as a multifamily. Just land development, pre-construction. We don't build it. And lately, we found that assisted living is something that's a super high demand. So our company decided to also branch out into acquiring assisted living facilities.
I had no idea that you were in that many different asset classes.
Well, now you know.
Okay, so
Been around for a while.
how long have you been in real estate?
Well, I got my real estate license in 2002.
Okay.
And I did it because I wanted to buy my first condo, and I wanted to keep the commission. So, well, back then I was doing accounting, right?
Yeah.
So, you know how accounting works. So they're like, you know what? It's cost me $200 to get a license. Why should I give up my $15,000, $20,000 commission check? And I love to learn. I mean, naturally, I'm just a learner. I always want to learn. I always poke around and see what's out there, and school doesn't scare me. So that's when I'm like, okay, well, I'm just going to learn about real estate. This is 2020, 2001, 2002. If you remember those times, real estate was hot. It was really, really hot, right? You could buy a house for no money. Reverse mortgage, remember all that time? So that kind of triggered me to get into real estate. And I want to get my license. I bought my first house, bought a few more houses.
What year was that?
2002, 2003, 2004.
So you bought your primary in 2002, and then did you
Bought a bunch of,
you bought a rental?
a lot, not a lot, but I would say 10, 15 of them.
And where'd you buy them?
Everywhere. I had one in Truckee. I had a few here in the Bay Area. I had them in Arkansas. I have them like in places. Some of them I've never seen.
Yeah.
And we did Airbnb with them. We did short-term rental. I did
short-term rental before the short-term rental was cool.
Yes, we did short-term rental. I mean, our goal back then was just to buy and flip because houses keep going up. It was so easy to buy. Right. And then 2007, 2008 came when the market didn't, withstand whatever happened back then. So I ended up short sell most of them except for my single family house.
Okay.
The primary house. I kept that one, but we short sell everything else.
Okay.
And I went back to accounting.
Okay. So you,
Went back to
it
do
was
accounting.
good, and then it hurt.
It hurt. And then I got back into my 8 to 5 job. And then I got back in the game in 2015.
Okay. So it took you 7 years to get over the pain.
Yeah, yeah, pretty much. Yeah, raise family, raising
Yeah.
kids at the same time. You need a paycheck. But the love for real estate was there, as you can
Always.
see, right? And just the love for not just real estate, but being an entrepreneur,
Okay.
right? Because with real estate I figure, is one of the easiest way for us to be your own boss. The opportunities out there, and the entry is easy to enter into that field.
Yeah.
Because if you were to go out and start a company, you need a lot of capital. Real estate is so much easier than that.
Yeah.
So to me, coming from maybe lower income class family, I didn't have the money. I didn't have rich parents that would give me the fund to go, okay, go and start your own company. So I start from where I was able to. And I picked real estate for that reason.
So then how did you go? I mean, a couple of questions as we set the context for you. In 2002, that's over 20 years ago. I feel like it is way easier and accessible today than it was 20 years ago. It's so easy to get the information, to watch people on video and actually see it.
Yeah.
It wasn't then in 2000. So how did you feel confident doing that? And then how did you even finance all of those?
So the confidence just came from, so back then there was Marshall Reddick.
Yeah.
I think they were there. I went to their real estate meetup club.
Okay.
They had people that they go, okay, I was selling these properties, and they have a list of the properties that you can buy out of state, and it was so cheap, $80,000, $90,000. And they also came prepared. So this property management company was there, and they go, if you buy this, I can help you manage the property. They get a lender right there, and they say, okay, this is your down payment. This is how much you can rent it out for. So all the numbers were already worked out when you go to one of this workshop. And I bought our state based on that, right?
So you did the turnkey rental model.
Exactly.
Okay.
So, and those were long-term rental, actually. In here in California, because I was a realtor, so I do have access to the MLS. Even though the information were limited, but it wasn't that much difference. I could still run comparables on the MLS. I still know the numbers. Properties over here and in Truckee, we bought a couple in Tahoe. I can manage. I actually self-managed, and I did Airbnb for that. Back then was VRBO.
Yeah.
We didn't have Airbnb back then. So those were easier
Okay.
because it's local, right?
Yeah.
And Marshall Reddick, I think they're still around.
They are. I just talked to someone who's doing stuff for them right now.
Oh, is
last
that right?
week. Yeah.
Yeah,
So
they're still around. I don't know if they've changed the way they present and they sell the information, but back then that's how it was. And it was packed with people. Like when you go to one of those workshops, and they did it weekly, and went to a few of those. I think the biggest thing is that you just have to take the risk, right? Because you could just sit there and think about it all day. I'm like, you know what? I could buy this thing for $80,000, 20% down, $15,000. Closing cost $20,000,
yeah.
right? So it wasn't that big of a risk that I have. I mean, it wasn't a lot of money that I'm going to be losing if things doesn't turn out right. But at least I get the experience. So that's why I decided, it's okay. I'll take a leap of faith, and I'll do this and see how it turns out.
Okay, so you went turnkey, a little bit of yourself, 2008, and then took a break, came back, and when you got back on your feet in 2015, what did you start buying then?
I came back and I worked as a real estate agent.
Okay.
So I started just to, you gotta pay the bills first. So I worked as an agent, and then 2018, when I invested as a passive investors. So I invested in someone else's deal doing land development. And 2019, when I became a GP for the first time doing land development, it's pretty much the same concept as what I invested in. So I found this sponsor that were doing a deal, and I partnered with her And I really brought with me the skill that I had back then with some real estate skill, but for the most part, it was my numbers skills, right? So I was able to help. I operate. I mean, I was helping her as a CFO of the company, and we did that land development deal, and that's kind of just launched me. In 2020, land development wasn't a big thing. 2021, when COVID came, and I started buying multifamily, because at least you get the cash flow, and multifamily was really, really hot, right after quarantine, right in between. So for some reason, and I caught that wave, and I started to work with, some partners and started buying apartment buildings.
I think that's very smart. You leveraged your strength to move from the LP side to the GP side. There are a lot of different gaps that a lot of groups have. I know that finances and being able to underwrite and do your pro formas is one for a lot of people. Capital raising could be for other groups, and marketing could be for something. So, I mean, figuring out whatever your superpower is and finding that gap is awesome.
Yep.
What was that conversation? How did you go from, hey, I could help be your CFO or just help you with your financial modeling? How did you make that jump? How did you start that conversation with the sponsor?
First I asked, you're going to laugh at this, so she said no.
She said no.
So she had an office in Saratoga, and it was an art gallery. Just on the outside, it's an art gallery. On the back is where she does all her real estate stuff, right? And she was there by herself, and I'm like, hey, Shannon, how about I just come and work? I was just like, I'm a real estate agent. Can I just come and hang out with you? And I'll just watch over your shoulder. I'm not going to bother you, right? You do your thing. And honestly, she didn't say no to that. Like, she was there by herself. So she'd go, okay, just come and hang out with me. So I came pretty much every day.
Okay.
I just show up for about 6 months, and she's like, okay, fine, I'll make you a GP.
So you said, I want to work with you now. All right, can I just co-work out of here, basically? And 6 months of building rapport.
Yeah, so you just show up every day, and again, you just have to be consistent, and just really show great interest. And of course, during that time, I help in whatever aspect that I could, primarily just on the numbers side.
Yeah.
And that's how I was able to establish my credentials with her, and enable for myself to become a co-GP on that deal.
Yeah. I mean, half the battle is just showing up. Like, how much can you actually show up?
Exactly. You just have to show your interest. You got to be enthusiastic about everything you do.
Okay. I know a lot of people, they do their first deal, and it's their first single-family house, their first flip, their first Airbnb, whatever it is. By natural progression, everyone wants to then move into commercial. It's bigger, it's shinier, the numbers, there's more zeros, more commas, all of that.
Right.
You have done it a few different ways now. You've entitled, you've done the actual multifamily, and then now you're moving into the commercial assisted living space. You started at the entitling, right? Was that the first deal?
For the commercial real estate, at the syndication, I started as the entitlement works.
And that was through your friend, your partner that you met over in Saratoga. Why did you at that time like entitlement deals?
Because I didn't know anything else. Okay. That was the only opportunity that presented to me about syndication. Because I always knew, kind of like deep down inside of me, even though I became a real estate agent, but I knew that I wanted to become a real estate developer. I had no idea what it means to be a developer. That's just, to me, a developer is someone to go out and buy a piece of land and build it up, right? And Intero has a real estate development department, but they don't develop anything. Basically, they just work with developers to sell their finished products. So I'm like, that's not exactly what I want either. So the opportunity came when someone came and offered the opportunity for me to become a limited partner, by becoming a capital partner with them. I saw that as an opportunity for me. I'm like, this is what I want to learn. This is what I want to do. And I'm going to be the capital partner so I could just shadow and kind of just get to know. You can only do so much as a limited partner other than just shadowing them, right? But that's still enough for me to invest a little bit of money that I would make interest on. At the same time, I have the opportunity to shadow and learn how it's been done.
Yeah.
So that's why that's how I got into entitlement, because that was the only thing that was presented to me at the time. I wasn't knowing about all this. There's so many type of syndications out there and so many different investment opportunities until I got into the business myself.
Yeah, I agree. I think there's so many different asset classes you can get into, and getting the first shot to do something is important. You just leaned in. The door was open, and you just leaned in.
Yeah.
And I feel like that's a very maybe the best way to go about it is you come in as an LP, right? Because asking some person who's already done it without ever investing in them, hey, can I now partner with you? I don't know, is the best entry. But then investing in the deals first, now all of a sudden you're already on their team in some way or the other. And then leaning into showing up for 6 months every single day, which is a long time. I like that. That's very persistent. And most people don't show up for 6 months, so there you go.
Well, I had to go to work anyway. and she was a wonderful person to be around. It's in Saratoga, right downtown. There's a little wine shop, and we just go have a glass of wine for lunch. I mean, it wasn't a bad thing. I think it was just to keep a company. I was there to shadow and learn, and I could still do my work. It's not like, if she was an unpleasant person, that would make it very difficult.
And then now, seeing that you've been the GP a few times, if someone's looking to move from the LP side or move from the 1 to 4 unit side into commercial and trying to co-GP and co-sponsor with someone, what are some realistic expectations they should have in terms of their returns? Because obviously, the lead sponsor is going to do a bulk of the work. What, as a co-GP for the first time, should you think would be a fair shake in terms of returns for your time and effort?
I think everyone is different. So we had a numbers of LPs that are co-GPs with us right now. And it's really hard to say, because some people work so hard, right? And some people don't. So, I have people that would just file the deal and then they stop there. Like, I'm done. My job is done. Like, I filed you a deal. Being a co-GP on a syndication requires a lot more than that, right? So a lot of it is just, like, I'm not the type of person who would give you a list of, here's your to-do list. You got to do this, do that. You just have to kind of lean in and poke around, and I say, hey, you know what? We have an issue right here. Can anybody help look into it? And so if somebody step up, you show that they really want to learn, because there's so many opportunities for you to be involved. You just have to say yes to it. Because if they don't, I ended up doing all the work myself, which I would say I do 90% of the work being the sponsor. But, I don't have the right to really give people a job, because they're not a W-2 employee. So, but then you kind of pick and choose. So the people who invest more time and effort into a deal, then of course I would want for them to partner with me again on the next deal. I'm probably gonna carve out more GP share for them, because I know they do more work. So I really cannot give a solid answer to that. It's just really depend on the person.
Yeah, no, I agree. Kind of a trap question there, I guess. But yes, it depends on, are you just bringing the deal? Are you only capital raising? Are you doing asset management?
And you cannot just raise capital, right? The SEC that's not legal. So even if you help bring in people, your investor relation, you still have a role and a job with the syndication, and you have to be as involved as, in the deal as possible. You don't just bring in the money and you leave. So that's not right. You cannot do that.
Yeah. No?
Just want to make sure I point that out.
No, I agree. Unless I guess you're running a fund, then that's a whole different thing. Okay. You went from entitlement, and then you switched to multifamily next?
Yes, so by apartment buildings after I do entitlement. And I was still doing entitlement. We just get deal basically entitlement approval for a 244 townhomes in Florida.
Okay.
So we're looking to sell that entitlement right now, and there is a possibility that we may build it out if we cannot get a good offer for it.
Okay.
So who knows? We'll see where that goes. So
Wait, and that's happening right now.
that's right now. We just got it like 3 weeks ago.
Okay.
Yeah. So
And so that's an entitlement deal that you got.
that's an entitlement project that I was working on.
And then how much did you get that for? How much?
Oh my
effort
God,
and time
that was so good because that was a piece of land, 20 acres, and we bought it for $400,000.
Wow. Okay. And then you
And-
entitled it.
Yeah, we spent about $500 to do the work, so all
Okay.
in about $1 million.
Okay.
And so, I mean, our projected, our pro forma number was supporting anything between 12 to 15,000 per lot.
Okay.
Just for the entitled, when we sell this as an entitled assets.
How
And
many lots will there be?
224.
24.
I mean, 244.
244.
Yeah,
So
244
3.6
townhomes.
million-ish.
If we could get $15,000 per
Yeah.
lot, if we get 10, then we're looking about, 2.5.
But you're all in for $1 million. And how long was that deal? How long
It
did you
took a
get?
little bit longer than we had projected it. So that one, oh my God, September 2020, we're 24 right now, right? I think September 2023.
Okay.
So it took a little bit more than a year.
Okay.
Yeah, we just got the approval. I had projected it to usually take about a year to do the entitlement
Yeah.
work. This one took a little bit longer. But again, it's usually 12 to 18 months, right? So we're still right in that time frame that we had projected it.
So you can profit anywhere between $1 million and $2 million without ever having to build something.
That's our hope, right? But
Yeah.
if we don't get an offer, then I know we had talked to multiple buyers.
Okay.
So we'll see if someone's gonna step up. And there are some bigger developers that look at it right now too, but because of like D.R. Horn was looking at it, Lena was looking at it, but because of the interest rate, and my partner over there had worked with, like D.R. Horn, he sold another entitlement project to Dior, just not too far from it. And so basically, because of the way the market is right now, they actually put in kind of a pause on it. I was hoping that I would be able to work with one of them, right?
Okay.
But we still had a couple, at least 2 that I know of that we're negotiating. So we'll see how that goes.
Okay. And then just for the newbies, entitlement in 30 seconds, like what are the different steps from A to Z to on a surface level?
Yeah, so with entitlement, basically, you don't build anything. The land still look the same from the time you buy it. The only difference is that the city that you work with will give you the approval for you to go out and build 250 households there, because during that 1 year process, you work with an architect to draw it out, what can be done there, and then you work with several engineers, including like geotech engineers, civil. There's a vendor team that you work with and working along with the city to really to establish that plans to take it from site plan to get that site plan approval, basically. And it starts with just a drawing from the architect. And then I don't know if you've seen the site plan approval. Once you have that is one thing, but building is another thing. So construction would be the next step. You do the horizontal first,
Yeah.
and you do vertical. And then after you finish building, then you have to deal with all the inspection. So
Okay.
then that's when the city came, and they probably
Yeah.
have 50 of them come and inspect your property and make sure, there's fire inspection, building inspection, sidewalk inspection, like all kind of inspection that you could think of, and they all have to check off, and then they'll issue you occupancy. So entitlement is the very first process, the very first step in getting the permit from the city to move forward to the horizontal.
And then financing entitlement deals usually happen how?
It's usually cash.
Okay.
So, it's a lender normally, if you own the land, they may give you, hard money, they may give you 50%. But for the most part, it's really hard to get a loan for entitlement, just because it's so raw.
Yeah.
And the risk is a lot higher.
Gotcha.
So it's
Okay.
all cash.
And then you moved into multifamily. What was the first multifamily deal?
It's a 17 units apartment in Jacksonville, Florida.
Okay. How'd you finance that one?
LoopNet.
So you found that deal on LoopNet. You got just a traditional commercial loan, I'm assuming.
Yeah. Yep. So we did that.
And you bought it for how much?
1.1.
1.1. And
Yeah,
how much
that's-
did you put into improvements?
Oh, that's a good question. I don't know a lot. It wasn't as finished as I thought it was. It's still a very good buy. I think the value play had improved to, if I have to put a number on it, I would say 1.8 2 years ago, maybe 1.6 now because
Okay.
of the interest rate.
Gotcha.
It's it's 16 units apartment plus a house. But they're smaller units, so the work was not a lot. So every time we have a tenant move out, we probably spend a couple $1,000s for renovation.
Gotcha.
And I guess the biggest expense which we are doing right now, as we speak, is to replace the septic tank. So this apartment still run a septic tank,
Yeah.
and that probably gonna be
It's a big septic tank.
15,000 maybe.
Okay.
Yeah, 10 to 15,000 is my estimate. I would say maybe all in the line of 15,000, then 10.
And you're still holding that one right now.
We still have that one.
Is the plan to exit it soon, or
I don't
is it just
know.
cash flow
I
and
don't
you're
know.
kind
I
of
mean,
just?
that rate is so high right now. It's not. I don't think it's in our benefit to exit that. And that one I didn't have an investor on, so it's just me and a couple partners.
Oh, so you just kind of JV'd it.
Yeah, we JV that deal. So really, there isn't.
Oh, there's no rush.
Yeah, there's no
You have
rush to
like a
sell.
20, 30-year fixed debt on that, and you're
Oh no, actually no. That was not that was a 5 years loan.
okay.
So we bought that. We still have a couple years on it.
Okay.
And then we can refi. Maybe 3 years. I bought that in 2021, I think.
Okay.
Yeah, so we still have a few
Yeah.
years. Good interest rate. So we'll see.
Yeah.
Hold it for a couple more years and we'll see.
Or just I mean, you've had some good value adds, so you just refinance, get your original
We could
capital
just
out, and
refinance. Yeah.
just keep rolling to the next one.
Yeah. The only thing is, the interest rate is double now. Hopefully it drops in a couple years, but because now I think we're paying 3.5%,
Yeah.
3.8%. So if we refi at 7%, our mortgage is gonna be double.
Very true. Okay, and so that was the entry into multifamily. You've now done a couple hundred units since then. How did you find your partners or your group to syndicate your first multifamily deal?
So my main partner, which I met him through a mastermind program, a multifamily mastermind program, and I've worked with him since. So that's Garrison Gilbert, and you have met him multiple times. Really good partner. I mean, this guy, he just work, which I love that, and lots and lots and lots of experience in real estate. Done nothing else but real estate his entire life. So I definitely leverage. I don't want to use that word, but we help each other, right?
Yeah.
So he definitely had way more real estate experience than I do. But what he's lacking and that I have is basically my financial background, right?
Leverage it again.
Exactly. So he leveraged me back. So we work together really well. 'Cause
Yeah.
I'm more of the back office number person. I read all the documents. I put together all the legal entities, and he's more of a hands-on out there. Making sure the properties are working, renovating. We don't overpay for anything, so it's just he's more operation.
Yeah.
So it's a really good partnership. So he is the co-founder of Investel Capital.
Okay.
And then besides him, we have co-GP on every properties we have. We have different co-GPs, some of them on a couple deals. But for the most part, the company, it's just me and him as the main person. And then we work with different folks on different assets, different properties that we buy.
Okay. And then have you gone full cycle on any of those deals yet with him?
We have sold, we have refinanced a couple of them. We just finished refinance one last week. This week, actually. It's Friday. Yeah, we just closed on Thursday, Friday, last week. So we refinanced one
what
deal
deal
that
was
we
that?
did. That was a small one in Los Angeles. We bought it for $1 million, probably worth about $2 million. And then we did a really quick refi because I did bridge on that one, and the loan was up. So this guy came in, no appraisal, no inspection, nothing. 5 days, he gave us $1.2 million. So
Okay.
I get to cash out a couple hundred. But it was a 5 days close.
Yeah.
Like they did nothing, right?
Yeah.
So on Monday we say yes, on Friday we close. That's how much, even, so they believe that property can sell for $2. That's how they were able to give me that kind of money. But as far as, so that one, we sold a couple properties also in Los Angeles, and then we also refinanced a few. We did, cash out refi, and then we keep them for long term.
And then now you're expanding to another asset class again, which is assisted living. Why are you really excited today about assisted living?
Well, because the demand is extremely high for the very limited supplies that we have. So if you, pay a little bit of attention to the news, right, we have, and I'm not gonna be able to reference the source, but we have every day, about 10,000 people turn 65 from now until 2030. Right, and by 2030, one of the study that I read showed that we need about 800. They're going to be about 800 people that turn 85, 800,000 people, but so they need about 800,000 units by 2035. But we're only building for assisted living. We're only building 5,000 per quarter, so 20,000 units per year.
Okay.
So you're building 20,000 units per year, but you have a demand of about 800,000 people by 2030. So you can see it's all supplies and demand. And so that's, I'm a number person. So that's the first thing that jumped out at me, right? So as we speak right now, I think there's about a little bit over 1 million, assisted living, not assisted living, but in general, senior living units out there that providing care for, and the senior population right now is about 70 million people.
Wait, there's only 1 million?
Only 1 million, a little bit more than 1 million. And this is done by, I think, the U.S. Census study. So as you can see, but, of that $70 million, 70 million people, not all of them want to live in assisted living.
Of course.
Right, so some may be in nursing homes, some just want somebody come to their house and support them, live-in caregivers, so on and so forth. But you could see the extreme shortages of assisted living and a huge number of demand. So that's the first thing that jumped out at me when I look into this assets class. Second was the ability I love old people. I just have the heart for children and just the older people, and I love them. And I want to be able to just, be there and help them and provide good cares for them. Being in this business, you just really have to have the heart for them. You have to love people. And I resonate with them, but I just have the heart for them. So I want to be able to do something good. And if you look at the average statistic, I was just reading this last night. On average, people, the senior pay about $4,500 a month to live in an assisted living facility. That's come out to be about $54,000 a year. They get 24 hours cares, right? They get food, they get help with medication management. So basically, everything is taken care of with $54,000 a year, right? Given that some, depend on the place where you stay, it could go up to 100. It really all depends, but on average, it's about $54,000 a year. The cost of hire a caregiver full-time is already averaged at $59,000. That's just to have somebody come and take care of you full-time. And then if you live by yourself, you need to have that. and you need to pay for your house, your rent, or your mortgage. You need to pay for food. You need to pay for utilities. So it's extremely expensive to live in your own house and have someone come and take care of you compared to moving into a facility or a house. We have residential assisted living where you just live in a house with 5 other people in California. In other states, I think they allow 10, for 55,000 a year, right? So it's just a lot more affordable compared to choosing to live by yourself in a house.
Yeah.
And then if you live in a facility, you got friends, you get activities, on top of 24-hour cares. There are people there that you can mingle with. So when I look at that, it's really a win-win situation for me, for us, for our company to get into this business, to fill that demand, that's extreme high demand, at the same time help people at the same time.
Yeah, I mean, it's an essential service.
It is.
No matter what, there will always be demand because everyone will always get older. Unfortunately,
Yeah.
I mean, that's just part of life. And it's an expensive service, and so for you, and I saw your post yesterday. You're under contract now for how many beds again?
This one is 44 beds.
Okay.
And it's a memory care facility, so we only take care of people with dementia. And so these folks have a little bit higher demand because of the level of care that we provide for them. But I'm very excited about this one because there is opportunity for us to grow the revenue through filling up the remaining of the beds. So for some reason, the current owner right now she likes to operate it at 70% full, even though the rooms are very large. So the room is just almost the size of maybe this room, so you can easily, and they are licensed for 44 beds. But I don't know, for whatever reason, she doesn't want to increase the capacity more than what she is operating at right now. Okay. So that's, to me, from the business perspective, we always look for opportunity to increase revenue. Because when you increase revenue, you increase net income, and that's how you increase the values of the property, of the assets. And so I see there is an opportunity for me to increase revenue at this facility by anything between $600,000 to $1 million per year.
Just by actually going to the capacity that it's licensed to.
Exactly. And increase the, and then we also decided that for this memory care facility, right now it's a private patient living there. Here in California, there's a very long list for people on Medicaid that need a place to live, and actually the government will pay for it. So our motto is to basically switch over from private care to Medicare pay. And
can you only take one or the other patients?
You can do both.
You can mix.
So our business plan is the first year. You can't just kick people out. I mean, if they don't pay. But essentially, we're gonna transition over from private care to government pay Medicare program, and it probably takes us, I would say, in my projection, in year 3 is when we are 100% ALW. Right, okay. The first 2 years will be just a transition over, and I want to work with the government pay Medicare program because they pay actually a little bit more too. So we're able to get about $1,000 more per bed compared to the private pay that they're getting right now. Wow. And that helps a lot. Yeah. Right, it helps a lot.
Okay, so rough numbers then. You would purchase this ideally for how much?
So we're in a contract now for 4.7.
Okay, 4.7. You increase increase occupancy by 30%. Increase even the average resident cost by $1,000 ish. So how much would it be worth after all that in your pro forma? What are you thinking?
I'm trying to be as conservative as I possibly can, and instead of taking it to 100% occupancy, I only take it to about 85, 86, just so that people have room to move around. Yeah. And doesn't mean that we're not going to push for 100, but my underwriting, I just go, okay, we're going to be at 86% occupancy in year 3. we're gonna switch over everything over to Medicare pay, so $1,000 more, and that would support a net income of about $1 million a
Okay.
year, and at a 12% cap rate. So you take, $1 million divided by 12%, you get the purchase price, the values of the assets. So anything within $10 to $12 million would probably, is that right? If you take $1 million divided by 12%, what do you get?
Can I do 12% here? It's like, is that enough zeros? Is it 8.3 million? Do I have that right? The missing column, 1, 2. I mean, $1 million divided by 12% is 8.33. So
Yep,
let's
there you
assume
go. So they
$8.3 million.
usually, with ALF, they are trading between 10 to 12% cap
Yeah.
rate. So they use, so that's 80%, 85% occupancy, 12% cap exit. You can sell it for 8.3.
So you almost double your
If I
money.
can sell it for at a 10% cap, then I think that's $10 million.
Yep.
So that's kind of how, that's how we kind of analyze the number, analyze the number. And then the key is to be able to work with a good operator. And I'm going to be as involved. I'm going to be very involved. I just got my administrative license today too.
Hey, congratulations.
Thank you. So, with that being said, that's the one
That's the
that we're
plan.
working on right now.
Okay. And then how are you financing that deal?
There's several ways to do it. You could either do an SBA loan, which they will probably finance up to 85% of the purchase price. You can do a bank loan, which they'll give you a little bit less, but the interest rate is significantly lower. And then a lot of people, and this is probably what I'm going to do, is do a bridge loan to a HUD loan. So HUD actually has the lowest rate, as you know.
Okay.
So we do a bridge, and bridge is a little bit higher, probably the same as SBA loan right now. We do a bridge for a couple years, and then we refinance that into a HUD loan.
Okay.
HUD loan, you could amortize that over 30, 35 years, and a significantly lower rate than a bank rate.
Gotcha. And then how did you find this deal?
I found this deal through networking.
Okay.
So like for me, I find a lot of my deals through just being out there, network with people, talk to people. This brought to me by one of the partners that we're working with. And so I think when she told me about it, it was under contract. But whoever that they were under contract with didn't want to move forward with it. So I told her, if it's for our contract, let me know. I might have interest because the numbers seem to be really strong.
And then you came in and you guys had your plan, and obviously it worked for your numbers, and
Yep.
here you are.
Yep.
What do you need help with, Elsa? How can I help you on the deal?
You can definitely co-GP with us. I mean, there's a huge demand out there
Okay.
for AOF, and this is definitely not going to be the only one. It's our second one, but second of many, right? So we definitely can partner on so many different aspects, right? But we can definitely discuss that to see what you can help us with, and then we'll maybe find more deals. Bring in more. I don't know. So we'll talk about that.
Okay. Looks like we're going to have lunch afterwards. And if you have any deals, drop them in the comments or shoot us a message.
Yeah.
Okay. Well, let's go to the last call, kind of the last questions before we close this out. What's been your biggest lesson learned over the last year?
If I could just go back and nobody knew the interest rate was gonna keep, increase from what, a 3% to what, a 7-8% right now. That's something that nobody was able to project it. When we did our multifamily underwriting, I usually add 10 basis points every year for exit cap rate, and that's definitely not enough. Right, so if I get to go back and underwrite my deals and look at it from a different angles, I definitely gonna have that exit cap rate so much higher than what I had projected it.
So always have it worse than you got it for. Is that good?
But I mean, like, I don't think anybody out there back in 2020, 21, 22 projected more than 10% basis point increase per year. That was really like a standard. A lot of them don't even included that. Their purchase cap rate and exit cap rate is the same.
Yeah.
Some folks like me, I do about 10 basis point, but looking back, it definitely wasn't conservative enough.
Yeah. Well, I mean, also, no one could expect that rates would spike that fast, that quick.
Exactly. And I've seen some syndicators sponsor now. They say we are, which I don't agree with them. So they say we are at the peak of the interest rate right now. So they actually, when they underwrite their deal, the projected exit cap rate is lower than where it is right now, which I don't think is a good idea. I think you should keep it at least the same. If it's 7% right now, I think you should. If you don't increase it, you should at least exit it at 7% rather than 5%.
That'll make a lot of deals pencil, though. At least on paper.
It will on paper, but I think that's just, who knows how long the interest rate going to stay this way, right? So I don't agree with that.
Yeah.
I mean, at least they do whatever works for them, but for me, I think that's too much of a risk too.
Yeah, I agree. I mean, it's always, that's one thing I always look for too when you're looking at how other people are underwriting their deals is what's their exit cap, what's the fees structure too. There's just so many different nuances that you have to look at a bunch of them to actually figure out how someone is thinking as they're putting a deal together.
Right, yeah.
Okay, what's been one conversation, one meal, one drink, or one relationship that's kind of been the biggest unlock for you?
There's a lot of aha moment, in my journey. But one of the very first person that I guess kind of helped me get out of my comfort zone was this really big broker, and he done $100 million deals. And he told me this worksheet I remember. He say, analysis paralysis. If you just sit there and you analyze, you're never gonna get anything done. And which is right. Like you could just sit there and analyze, but you're not gonna go anywhere. So that's how I was able to just kind of just like, I'm gonna take a leap of faith. I'm just gonna get out of my comfort zone. I'm just do it. What's the worst case gonna happen? Right. So that would probably be the one conversation that I've had, and I took that advice to heart.
Oh yeah, totally. I mean, so many people get caught up on looking at the numbers too much, or reading the next book, or listening to one more podcast, and eventually you just have to go put an offer.
Too many voices.
People,
You sometimes you just have to tune it out and listen to the one voice that you.
And you'll also never have the entire blueprint figured out. You can have your contingencies, but you're just always focused on what's the next immediate fire. Let me solve that fire. Cool, now let's move on to the next fire because there'll be another one.
Yep.
So you can't plan for all the fires.
Can't. No, you just never know what's going to happen.
Last question for you is there anything that you need help on, or what things are you looking for right now?
Well, we're always on a search we want to grow our company. That's our number one goal, is continue to grow, invest in our capital company, and we want to expand. So, we're always looking at our goal, moving forward. We still do multifamily. We still have a few assets that we're managing, but assisted living is probably one of the asset class that I want to maybe emphasize, focus more on moving forward, at least for the next until 2030, because of the tremendous demand out there.
Yeah.
So, again, I'm going to put that word out there. We're looking for opportunities to grow. We're always looking for partners to work with, because this is, there's just the ocean of opportunities out there, and you can't possibly do this by yourself.
Yeah.
Right. So definitely open to new deals, new partners, and if you have any question, reach out to me.
Okay.
I'm on social media a lot.
And how can people find you on social media?
Yeah, so Facebook.
Okay.
Facebook, just Google Elsa Nguyen, and then it's the same on LinkedIn. I'm not on Instagram, and I'm not TikToking. So
Yeah, maybe we'll convince her.
right. So my two biggest social media platform is Instagram and Facebook.
Okay.
And then our company, of course, investnowcapital.com.
Okay. And I will leave that all linked down below in the description. If you enjoyed this episode, please make sure to give this a like, and then share this with anyone else who's interested in real estate investing, multifamily, assisted living. Elsa's dropping all the gems today. But Elsa, thank you for jumping on the show, sharing your story, and
Of
how to get
course.
started.
Such a pleasure. Thank you so much for having me here today.